Hello, Warriors. Hi, Angelo, Alexander, Bran. How's everyone doing? Richard, how's it going, buddy? I don't know if we could call it Turnaround Tuesday since yesterday was a bank holiday, but let's go with it anyway. Good Turnaround Tuesday because there is a shot for a few reversals here. And I want to start off with Ryan. Oh, good morning to you, Ryan. How are you? Are you around?
Oh, he's not here yet.
Oh, okay.
So good morning.
Good morning, Stel. Good, buddy. So BOE was in again, trying to support their version of inflation, like the TIPS in the US, their inflation gilts.
Yes, index-linked gilts, so linkers they're called, and they're going to be buying those as well. But from what I read, only at prices at or above the previous night's close, which is interesting.
Right.
But yeah, they're going to be, they're also launching temporary expanded collateral repo facility. It's full of acronyms, you know, all this stuff. So basically they're doing more to help markets. So they're the first central bank that's kind of, I don't want to say panicking, but they are paying close attention to the markets and liquidity conditions. And let's face it, the UK is currently in a worse situation than most other Western economies, and that's why I guess they were first off the blocks. I would dare say that other banks are going to follow, and probably sooner rather than later, as Steve says.
Yeah, weren't they the first central bank to tighten even before us?
Oh,
they raised rates first?
I think so.
Okay, because you know,
Ryan.
Hey, Ryan, because you know I was taught that BOE leads. Okay, early in my career during the Flintstone era of trading.
Hey, Dale, stuff has changed since like 1936. So I mean,
I don't think
it's
so,
a different,
it's still happening,
a completely
Blake.
different market now, man.
They were the first. They led it. If they were the second, I couldn't say that, could I?
We led the recovery at the banking crisis as well, I believe.
Yeah. So I don't know. The more things change, the more they stay the same. There's nothing new under the sun. Go ahead, take the screen.
Oh no! I want to let you go ahead. I
don't want to say any more irrelevant things. You know.
No. I think it's a good conversation to have.
All right. So things have changed.
Continue on, please.
All right.
I was just actually coming in to harass you, man.
Okay. So you were being the devil's advocate.
No. I was seriously. I was just, you know me. I like to make fun of your age and Stelios's bald head. So
yeah, I know. So pound.
I thought he was going to say bulls there. Sorry.
I think it's interesting. Huh?
I thought he was going to say Stelios's bulls there, but okay, he said bald heads. It's good.
Yeah. Anyway, so with the gilts making new lows on their, I don't know if it's the inflation protected or not, but I saw higher yields, new lows in gilts. Cable's given back very little. In fact, 38% compared to, we're getting a little bit of a bounce from 61.8 in euro, but much more relative strength in this pattern. What do you think, Ryan? I mean, I know a lot of people don't want to buy it here because they didn't do anything in here, and it still seems like, where you have to put your stop, it's too high risk. Because really, you have to risk the lows. So there, I would say trader psychology right now is, well, I'm going to wait for 61.8, so I have a tighter stop, or 78.6, so I have a tighter stop. And the most bullish thing a market could do is not accommodate people here.
Yeah. I mean, this is pretty much bang in the middle. 110. It's pretty much in the middle of the highs we saw at 115. And that renewed support at 105, whatever it was, 50 odd, which was that 1985 low that showed up after the spike down. That to me is my level, that 105.50 again.
Okay.
So we're bang in the middle. We're bang in the middle of that. So the market is probably sitting there thinking, okay, well, the Bank of England are in again. And it should be noted that they are only doing this to support one industry, one small problem. They're not here supporting the whole of the bond market.
The pension funds.
Yeah, and they're putting
is that really a small problem?
Yeah, it's a small problem that's been blown into a bigger problem. The only thing is, you know what it's like when you get a leaking pipe, you stick your finger in it, and then the leak appears elsewhere, and you stick another finger in it. You know, you don't want to get to the point where you're plugging too many holes with your fingers. But it is a particular problem because you look at people saying, "Oh, gilts are up at highs again." Well, so's 10-year yields, so European yields. You know,
but the pound's not back down here. When gilts crashed, they were here.
Exactly.
Cable was here. So I'm getting a message here. So they may be some, and you know, runs counter trend. I know that we're going to have the Fed guy at Trader Summit, but I read a piece by him, and he said just like the Japanese when they went to yield curve controls, and any government that comes in to start supporting their bond market, it equals a weaker currency. That it ends up being the result. I mean, this is only short term, but short term that's not the result I'm seeing because they're still in there doing it, and the cable's only correcting 38%.
Yeah, but the numbers are small. Yeah, the numbers are small. You know, they bought just under a billion of these linkers, which is pretty much all they're doing is buying the same 30-year duration that they were in gilts, but just buying the inflation protected ones. You know, the tips linkers are the UK tips, if you know that.
Because I know do you guys have an insurance fund for pensions? We have an underfunded one here in the U.S. that, you know, would cover a few weeks of people's pensions if there were problems. So,
we all have that sort of coverage and stuff. So yeah, no one's. Well, I don't know. One of our ministers came out this morning and said that everyone's pensions are fine. So that's probably more cause of panic than.
Yeah. Can I get an advance on my pension?
Yeah, exactly. That should put a run on it. If a government minister says they're okay, they're probably queuing out the door at the moment.
The other action is Canada. I mean, the commodity currencies were the weakest, and Canada was not as weak as Aussie was. And, you know, making new lows, it took, you know, another push up for it to make a new high. And that's pretty glaring divergence on the daily. And even lower TFs, it's not confirming. This could be an important day in Canada. And if it is, maybe even get a reversal in Aussie.
That's looking a big level, that 38, 40, 50 area.
Yeah.
I mind that myself. I know one of the guys in the room jumped on a short up there. I mind it. I think it's worth a two-way, you know, maybe a short into 45.50 and then look for a stop reverse if it goes.
Yeah. Anyway, that's and the only other thing I've noticed was silver got down to the 61.8 level. Hasn't been that great of a rebound. Gold has actually had a better rebound. And I know we're back under 1678, but can't both of these putting in higher lows just be the break to buy that everyone that was, you know, commiserating about missing this wave, that this is, you know, if we have put in a low, that should be buying this pullback and this correction and this stuff?
Only if risk recovers and equities recover. If they don't, I even though silver should be a lot higher, I don't think it's going. You know, it can't go the other way to equities. It really can't. Okay. So we have to wait.
Yeah, and that's a key point. Still, you know, we spoke about on the flow show. I think the metals they're not leading anything. They're on the lead. They're following around what equities are doing, what everything else is doing, and that makes it a bit difficult to trade it because it's not leading anything. You know, when metals are, you know, it's risk on, the metals are flying and they're pulling everything else up. That's an easier trade on the text, but when they're just being dragged around by other things, it makes it a bit more difficult to trade.
Yes.
Okay. Well, I'm just saying right now. So we'll see if we get a breakdown or they're going to turn the S&Ps here. But you're right. That'll be the big test. In fact, you look at the miners. If the market gets hammered, S&Ps I'm talking about, if they get hammered, probably want to see GDX, and I read Walsh's stuff yesterday, hold right around here at the 23. And for the first time, it's really been pretty good outperformance in the miners compared to the metal. They were lagging and that all the way down, but I mean, you take a look at some of these moves that you had. I mean, they almost got back to these highs. So, you know, some pretty powerful moves out of wedges. Still looks like a breakout to me in the miners, and at least in the silvers. And here's another one. So when I look at this, I go, I wouldn't short it.
Yeah, I agree with that.
Okay.
It just I'm just not sure about the, you know, I think they will
sure.
break out. Yeah, you know, I just think they have a little bit more to go probably before we see the proper.
Yeah, I've changed my style a little bit. I'm not trying to be perfect, so I'm just like, you know.
Hey,
go ahead.
Hey Dale, you know, I'm sorry, I was just tuning back in as far as can I show you guys something on precious metals?
Oh yeah.
No, go away.
Okay,
No.
I'm out of here.
Get in the queue.
Well, hey, you know, and actually, I want to go back to like the sterling conversation. And Dale, I think that's a great observation, by the way. You know, going back to you talking about, you know, the Bank of England leading. I will come back to the sterling, but I wanted to show you guys a couple things with precious metals. You know, I was updating just if you're, you know, ForexAnalytix user. By the way, did everybody see?
Yeah.
We are at 189 a month. So if you missed your opportunity to get ForexAnalytix at $99 a month and you've been sitting on your hands, sorry, prices have changed, and this is a forever change. So like I was, you know, been saying, if you didn't take advantage of that, you know, it's almost what is that, 100% higher in price, close to. Is that right, Stel? My numbers right?
From the offer that we had, from the offer that we had, almost, from the previous price less, but yeah.
So anyway, but I wanted to show you guys so updates.
It's still cheap in my opinion.
It is. I mean, you got a whole team of analysts and a chat room that looks like this.
2 pips.
I mean, look at this. This is from this morning. I've been awake for an hour. Somewhere around here, I said, good morning. This is just the general chat room. This is not the other chat rooms, the macroeconomics chat room, which is Flowonomics, the trades room, the Spanish room, the news and research room. This is just from this morning. All right. That's our community. But if you were looking at the app here, you got an update here on, you know, this is obviously gold, right? And here's silver. Right. And the one thing I want to point out here with these precious metals is take a look at gold. We held the 618 and we didn't create a lower low, which is interesting, right, Dale? Yeah. So we didn't create a lower low. We also held the 618 in silver, and you can see the aggressive bounce that's coming through. So when you see things like that, how does that make you feel if you are, like, let's say you're a dollar bull and you're you know, you've been just playing the dollar to the long side the whole time? Aren't you going to get a little nervous when you have precious metals ripping like that?
I think everyone wants to sell a new high, and maybe that doesn't happen.
That, you know what, Dale, that you know who else said that this week or this last week on Friday? Jim Welsh. Yeah, your buddy Jim. Yeah, Jim's like,
I know why he would say that. Because of the RSI. He's saying that because the RSI confirmed at the highs.
Yeah, right, exactly. It's like, okay, well, we got that confirmed high here. So if we hit a new high, you definitely sell it. But really, I mean, how many people are waiting to sell dollars at new highs and they just might not get it, especially with CPI data coming out on Thursday. So I don't know. I'm looking at this reversal starting to brew, and I'm gonna point out a couple of things before I do that, I want to just, you know, go over the Aussie, the Kiwi, and the Canadian specifically. But before I do that, I'm going to go back over to the sterling, and I need to say this. And Ryan, I don't know what you make out of this. I know you guys were talking about it a little bit earlier. I had to focus on a few other things. The 38% retracement has held in the sterling. You can see that, you know, that very aggressive move, which Grega is listening in, and I'm going to get his comments in just a little bit. This looks like a very impulsive reversal from the all-time lows, and we were holding up, even with the gilt market coming like just absolutely unglued yesterday. I mean, let me. It's here somewhere. Let me just go ahead and grab. Oh, there it is. I mean, here's the gilt market, and you had yields were ripping back up towards the highs. I was so surprised that the sterling held up yesterday. I was watching it yesterday going, am I, I didn't short it.
Put the US 10-year up. Up. Oh,
I know. No, I'll do it. Just give me a second.
Oh, look, I've broken it now.
There you go.
So exactly the same.
You're talking about UK gilts. Yeah.
Yeah. So no.
I
so
thought
the
you were
US
talking
10,
about the sterling.
no,
Okay.
The moving gilts is exactly the same as the moving US 10s. There was no.
So why are they calling it a crisis in the UK and not here? I don't understand why.
France wants to spend 100 billion fighting inflation. No one's batted an eyelid. How are they going to pay for that? They announced that, I think, this morning or last night. No one's batting an eyelid. The UK wants to do a few tax cuts, and everyone's throwing their toys out the pram.
Speaking of which, if you watch Boons yesterday, they just absolutely got crushed there.
Exactly the same picture. Exactly the same picture.
Yeah.
So you have to differentiate what is moving what. So yields moving yesterday wasn't anything to do with the UK. It's just a general yield move. Hence why cable didn't make the same move it did when we had that first high yields. You have to differentiate what is driving the market at any one time. And so as much as in the press it's all UK is imploding again, well, cable doesn't say it's imploding again.
Yeah, and you're absolutely right. And so that's a great point. Ryan, I agree with that. So anyway, I guess what I wanted to make, the point I wanted to make here is actually the sterling's holding up pretty well. I would be really careful about being on the short side of this. And I've kept my hands off, the pound. I've really not touched it. Because I hadn't been sure how to play it. So when I'm not sure, I just, leave it alone. But I will say this, that if I was short, I would be probably a little nervous right now. Speaking of which, I wanted to show you guys this. And then Greg, are you here? He was here earlier.
Yeah, I'm listening.
Hey, I would love to bring you in, and we can all maybe talk some Elliott wave counts with you. Maybe you can show us some of the charts that you're seeing. But let me go over to the Aussie dollar. So the Aussie hit the 161% extension. If you guys didn't see that, we have a bear flag. We hit new all-time 2022 lows, right? Very bearish move in the Aussie. However, we just hit the 161% extension. Now that's the golden fib, and you can see relative strength was divergent down here too. So as we hit new lows in Asia overnight, right, relative strength did not. So that divergent relative strength right there suggests to me that you got to be really careful on the short side of the Aussie. Could take us a little bit higher now. Kiwi also fresh new lows, divergent relative strength, and a reversal. So now you got a false breakdown in the Kiwi.
Yeah.
Right. And let's go over to the dollar Canadian, which there's been talk about the dollar Canadian in the chat room this morning, especially when it failed up here. And Amanda pointed out this, this candlestick reversal. That is actually an evening star and a false breakout. So you put all that together, what I'm pointing out here with commodity currencies turning around sharply.
And they were the
weak sisters. I wouldn't want to be short risk right now, Dale, right? Yeah. And especially if the S&P is not hitting new lows.
At least not the dollar.
I don't think you want to be long the dollar, but also short risk. I mean, look, the S&P is not hitting fresh lows. True. And you got all these commodity currencies showing reversal. And you've got really critical inflation data coming out on Thursday. Here we are a couple of days ahead of that. And I think what pushes the market to new lows at this point, the S&P's, to break below this 3,800. And guys, if you don't know why this 3580, 3560 level so big, you have to go all the way back to the COVID breakout here. This is like major support. I would call it really key support for the stock market right through here. So, what's going to break us down from here is going to be stronger inflation prints. But if you guys are and I think most of the market's starting to question, hey, are we gonna get new highs in inflation from here or stronger inflation? Maybe we're starting to see some disinflationary data come through the market. I think people are going to think twice about, at least between now and Thursday, about establishing fresh quote unquote risk shorts. So what I'm trying to point out here is be very careful if you're on the short side of risk. And that's the point I wanted to make today. Grega, what are you seeing in the markets? And we'd love to see your charts, because I know you obviously are the Elliott Wave in-house Elliott Wave analyst for ForexAnalytix. You come in here and post your charts, but I want to see your current setups, even though these are all current from today, but I want to see what you're looking at and how you're feeling about this market.
Yeah, sure. Let me grab the screen.
Yep.
Okay. So last week I was also on the flow show when Ryan was away, and with Cayman we talked about also about US yields. And notice actually that when looking at the US notes, we are here running to the downside into some final stages of this current fifth wave. So I think that yes, this week could be very interesting. We could face some limited moves here. But so far, I still think that there is room for slightly more weakness here. Notice that we are still not making a new low here on the US note. So in my opinion, there is still room for slightly more upside. But as I said earlier, I think that this cable and euro, which are doing quite well compared to commodity currencies, I think that these two could do quite well when these US notes would actually finally bottom. But for now, it looks like that Aussie, Kiwi, these are all in the fifth waves that could be in the final stages of the higher.
So where would those 5 waves complete? Like if you're looking at like the Aussie, because I was just pointing out the 161% extension, is it possible we stop right here?
Yeah, sure, it's possible, but then I would have to see a recovery, let's say back above 64.30 around there to make sure that low is in. I'm looking for the level here around 161, which is actually this triangle measurement taken from the widest slack of a triangle, measured from the breakout point. So you can see that was a very nice slack for a wave B. So that was the widest slack of a triangle. I take this distance and compare it from a breakout point, which was here at 670. So that's my downward projection for the Aussie. But we are in this area. It's very hard to say where we will bottom, but the important is, as you said yourself, that we are most likely in the final stages of the higher degree trends. And I think that this week we could see a reversal. However, if you look at dollar Chinese yuan, which is obviously very important as well, you can actually see that we are not here completing the uptrend either, not yet. Okay, that was a very nice free wave drop. You have this broken bullish flag. So I'm afraid that maybe this dollar Chinese yuan will continue to the upside, and that's not good for. It's not good for gold. It's not good for Aussie, and the US yields are also obviously still on the rise. So I would be careful with metals. I know that these 61.8% pips that you talked about are very important key technical levels, but maybe from my perspective, we will see just temporary rallies there.
Got it.
It looks a lot like the dollar. That chart looks like
it does. I mean that
yeah,
you're
sure.
right, Dale. But the problem that I always have with the CNH is it's managed. But Ryan, you trade the US dollar CNH quite a bit, don't you?
Yeah.
How are you viewing it here? I mean, looking at Grega's chart, what are you seeing with it? I know you've been playing it pretty aggressively the last few months.
Yeah, I managed to catch the short 718 and ran it down to 706. I got chipped on my trailer overnight. There's a bit of a zone, sort of 716 to 719 and a half, and we're just messing around in that at the moment. If we break above sort of 719, 720, then we're perhaps heading back towards the highs. But we've got this big National Congress coming up the weekend. Lots of comments coming out. Also some comments potentially for them to cut the reserve requirement ratio, which is the big one. Data has been rubbish. We've got services going into contraction earlier yesterday or over the weekend. So yeah, I think again, this is one of those ones we're a bit undecided where we're going from here. Technically needs to get above that 719 and a half to push up. If it fails and we're back below 716, then we're heading back down again.
By the way, if you guys aren't looking at it right now, S&P, thank you, Ryan. S&P is blasting higher right now, and so is the Dow and Nasdaq's. They're all cracking levels that they couldn't break. The futures couldn't break in European trade. Sorry. Go ahead. Grega, we have about 4 minutes. Do we have any data coming out today, Stel?
No.
Let me check. No.
Okay.
We had the UK data earlier. Yeah.
If maybe, as you said, maybe if we will see some very strong supports like for Aussie and Kiwi, who are making this failure breakdown, and dollar cat as well. Well, I still think that one of very strong moves that we could experience when all of those currencies will turn around is dollar Mexican peso. I think that this one is sitting on some very important trend line here. So when this one breaks, I think that we could see a very strong move to the downside. But of course, the overall dollar sentiment should change. But I think it's very good to be prepared, because this one, Mexican peso in general, is doing quite well compared to the dollar in general. So also you have crude oil, which obviously is breaking out as well, out of this wedge pattern that I've been tracking for the last few weeks. And at the same time, here on the bottom, we have dollar Mexican peso. So if this impulsive recovery will resume, which I think we will see $100 maybe by the end of the week, I think that dollar Mexican peso will finally maybe break 19.70, which could be a very important breakdown level.
I agree with you, and I love it.
Yeah, so I mean, here I also shared this chart on the flow show. I mean, it's very clear, nice correlation. Look where the US dollar, Aussie inverted, cable inverted are trading, and look the dollar Mexican peso. So we know what to expect if this turns around.
Yeah.
So
nice work, Wizard.
Okay, so let's we can take a look also very quickly here on the S&P 500. Okay. So on the S&P 500, I think we are in a wave C, as long as we are trading below 13,885. So watch out. I'm watching for and hoping for another break to the downside before market will stabilize, because if that would happen, then we would have all needed subways for a completion of this counter trend movement, because zigzags are made by 5 waves in wave A, wave B rally, and then 5 waves drop for a wave C. So I'm waiting for this pattern to complete itself. If suddenly we would rally, as Blake said, if we hold these previous lows and we see 38.85 without completing the 5 wave drop for a wave C, well, then things will get a little bit more complicated and ugly in this higher degree range. So watch out for today's price action. The key resistance on this intraday rally, in my opinion, would be at 36.70. This was also the high of the week after Sunday open, so watch out for this potential retest before further sell-off. Okay.
Thank you, buddy.
Thank you. You have an interview, right?
Yes.
Okay.
Really appreciate you being here, Grega.
Yeah, Grega, that's a great view, and thank you so much for stepping in. And hey, wait, before we go, really quick, Dale, I just want to say this. Let me go ahead and get on. And who do you have coming in today? You have Pedro da Costa, right?
Yes.
He is really one of my favorite. He's the guy that's in the room during the Fed after the Fed meetings, and questioning all the Fed chairs, and he asks the best questions always, and I'm glad he's here. Hey, really quick before you all listen to Pedro, make sure you check out the Trader Funding Program. If you haven't had a chance to just watch a 2-minute video, we have a lot of people that are trying to access our amounts of money, our larger funds. And if you want access to larger trading accounts, make sure you check out the Trader Funding Program. You just have to take an assessment, pass it, and then with that you join the ForexAnalytix community for a certain period of time. Because we don't want to leave you out there on your own. You're in our chat rooms, you have our mobile app, you have our whole community, our private webinars. So this way you have ideas, and you can talk to other people that are in the Trader Funding Program. So you can have fresh ideas to trade it. So anyway, check out the Trader Funding Program. That's our sponsor today. And Dale, I'm going to go ahead and pass it over to you.
Okay, thank you, Blake, Grega,
Thanks,
Stel, Ryan, Dream
Thanks,
Team.
everybody.
Okay, thank you, guys. Pedro DaCosta, welcome back to F.A.C.E.
Thank you so much, Dale. Nice to see you.
Great to have you. Great to have you here, Pedro. So I guess I'll share my screen. You want to use cameras? Doesn't matter to me. We don't
Doesn't
have
matter. We can do it if you want. I'm here. I'm ready.
All right. Well, okay.
I'm ready to go.
Let me just
get a little light in here.
because I do want to talk about your most recent article, Pedro.
Absolutely.
And, so let me just get back up here. So you sent it to me the other day, and I think it's going to be an important issue. So tell me what your take is. So we have another mandate by a central bank that may be causing global financial market instability. That stability is separate compared to rates to maintain it. Do you think the BOE is maintaining financial stability?
They're trying their darn best, but it's looking pretty dicey right now, and I'm really curious about how the week is going to end when they finally, when they try to pull out of that market. It doesn't seem like the market is quite functional there.
Okay.
But the genesis of the article that you're showing really is basically the markets went from hunting. The market is obsessed with the Fed pivot, as you know, because everybody knows that the big moment to make money is going to be when that turnaround happens, right? And we went from trying to ascribe a potential pivot to various macroeconomic events. Maybe the job market will slow down enough. Maybe a recession prospect will lead the Fed to pause. But then the Fed pushed back against that hard, starting in Jackson Hole, and they've kept going. And then we had this financial instability coming from England and the Bank of England intervening. And then the question became in markets, okay, well, we might not get a macro event that will dissuade the Fed, but surely financial instability will, because that's the kind of thing that truly drives Fed pivots, right? And the point of the story was to actually argue that the bar for the Fed to intervene is still extremely high. It's not that they would let markets crash, but actually it is that they would let markets crash. They simply wouldn't let markets become so dysfunctional that there's no pricing and that markets are completely frozen. But it would essentially take a market freeze type of event, whether it's in credit or in treasuries, for the Fed to actually intervene. And even then, they might not intervene, at least not initially, by pausing rate hikes. They would try to intervene using their various special emergency lending facilities that they've concocted in the past. They can revive those.
Concocted, I like that. So it's like making a cocktail.
It kind
So
of is, yeah.
Anyway, so Pedro, tell me what's the difference between what gilts have been doing for a few years and what our treasury market has been doing for a few years. Our gilts that much more, they were exacerbated and magnified for a few days because of potential pension crisis. Are things really that different in the U.S., where pension funds had to go out on the risk curve to get their 7-8%, and they're probably sitting on some coupons that are discounted quite a bit from when they were buying them? Where's the difference?
I don't have enough visibility to know how different it is, but my sense is that it's not that different, right? Because reach for yield behavior was global, and these pension funds likely behaved in the same way. So, we're never going to know, nobody had UK pension funds on their bingo card for financial risks, right, for 2022, but here we are. So I think we are now entering a new phase of this cycle, which is, basically a financial crisis type phase, where we're going to get different types of events popping up here and there, and they're going to seem unrelated, and people are going to try to portray them as local. But to your point, I don't think it is a local phenomenon. I think it's the first pipe to burst, if you will, in a global financial system that's kind of saturated with pressure right now and just kind of waiting to blow.
Are we in a sovereign debt crisis?
I'm not sure if it's a sovereign debt crisis or if it's a credit crisis. I'm not sure how we're going to end up characterizing it, but I think UK is very close to a sovereign debt crisis. The US is different, of course, because people will pile into dollar assets as the world kind of collapses, and so that's the advantage that we have, at least temporarily. But that doesn't mean that, we also have liquidity problems in our own treasury market, even though it's supposed to be the most liquid, safest market in the world. So it doesn't mean that those problems aren't going to come home to roost over here. So my sense is that it's kind of a waiting game, but we are going to have some kind of financial event here in the States as well. I just can't predict what form it's going to take.
Okay, what do you make out of the gilts making new highs? And the same day, British pound was trading about 103 down here on the panic day, Pedro. And even though gilts have made new lows, new highs in yields, there's been very little give back in the currency. Because I was reading your friend, and who you introduced me to, a Fed guy, and he was saying that anytime government steps in and begins a bond buying program, that it leads to a weakening of the currency vis-a-vis Japan with their yield curve control. So at least short term, that's not what's happening, because gilts made new lows without the pound well above the lows of the panic. Any ideas about that, huh?
I mean, I don't really. I think the market is just so dysfunctional at the moment that it's hard to read into that level of detail, basically.
Okay, well then why don't we read into this? Do you think that it's time for the G19 at the IMF meeting this week to have some type of communique about the wrecking ball, the dollar, which I think is behind a lot of this, that perhaps if the dollar had not been as strong, yields may not have gone up as much in the UK. They're higher than us. I was taught the BOE leads the Fed. So couldn't they come in and intervene and, or at least talk up the dollar, jawbone it, and that might be a band-aid and they'd still have cover to raise rates, because intervening against the dollar, which it's easier to bring your currency down than to lift it, right, would give them cover, because they could say it's for financial stability and continue on their rate hiking path.
That's a good point. The problem is, I don't think we're there yet, because the Fed doesn't see this as a crisis moment that's yet affecting the US in the same way that I'm looking at it. They see it as something that's happening over there, and they think the Fed will say, and officials that I talk to will say, our mandate is domestic, and as long as nothing is broken here, we're not going to intervene. The other issue is that, we're talking about different principles involved, right? We're talking about central banks versus the treasuries coming together and making that decision, which is, a whole different ballgame. So I don't expect that kind of verbal intervention just yet. I don't think we're there yet. And people are talking about a new Plaza Accord, but I also, again, I don't think the dimension of the move, even though it's large and it's catastrophic for some emerging market countries, it's not yet at the magnitude, at least in the developed world, that it was when we got the Plaza Accords in the 80s.
Well, I don't know. This type of decline in cable, this is not an emerging market currency. This is pretty close to a collapse, right?
No, you're right. And the UK, I mean, it's
and
been
the
a joke.
euro is not the Thai baht, and it's it's been melting like a glacier during a climate crisis for a while too. So I mean, these are not minor currencies, and the yen. These people actually are also our ally, and if things break there, isn't it going to cost the Fed more to come and be a lender of last resort to foreign countries, or you think they're just going to let them go down?
No, they're not gonna let them go down. They would create some kind of, as I said, emergency
concoct a few more things.
They're gonna find a way to keep markets liquid without looking like they're bailing them out, I think. But to your point, I heard on Bloomberg this morning that the 10-year JGB hasn't traded for 3 days.
Oh my god, I didn't know that.
Yeah, which is
they're keeping
impressive, fact, and it shows you that
you have to make an appointment.
Exactly.
To get a trade-off, Pedro. Let's see. I'll see you JGB next Tuesday at 9:00.
Exactly.
To liquidate a bond.
You would think that the government bond market would be happening 24 hours a day, right? But
yeah,
it's
and the yen is also approaching its intervention levels that we had over 145. We got to 590, and today, last night, got to 586. Will BOJ come in with another 1% of their reserves and try and stop it? Do you think they're putting out phone calls to other central banks? We have helped the Japanese before, and have been successful at times with turning the yen.
I think the BOJ would probably appreciate, and the Japanese finance ministry would probably appreciate some help from Treasury, but it's unlikely to get it because getting the dollar higher is part of the inflation fight. In fact, my colleague Tim Cooper argues that the Fed has this whole time has an unspoken strong dollar policy where they're actively trying to strengthen the dollar. So I don't think they want to quite undo that with the strength that a market intervention would lead to. One of the interesting twists to me is that people are thinking of financial stability as potentially leading the Fed to pivot, right? But it could actually lead to a longer lag between now and the Fed pivot, because if the Fed has to intervene with financial stability issues, it might take a hit to its credibility, right? To its inflation fighting credibility, which might lead to inflation expectations becoming somewhat unanchored, which would then lead the Fed to have to react on the inflation front further down the line, and therefore prolong the inflation problem, which would mean that they'd have less leeway to eventually pivot and cut rates. So
I mean, really, how can the Fed compete with OPEC cutting back 2 million barrels a day? Isn't it? I mean, it's a supply issue. How are its Fed funds at 4.5 going to resolve that?
No, they can't, and that's been the problem with fighting this inflation the whole time. A lot of this inflation is a supply issue over which the Fed has no control. So all it can do is, wreck the economy essentially in order to get supply and demand back in balance, but that not in a positive way. And it's crushing demand in order to get it down to levels that are matching a challenged supply picture. So it's not a good outcome.
Yeah, because wasn't it Volcker? It was more of a demand problem, except for the embargo, the OPEC oil embargo.
That's right. And the argument that Fed officials make today is that the Volcker inflation started from a period where we'd already had kind of 10 years of inflation edging higher, and therefore people already expected inflation to be built into the system. Unions negotiated for wages based on that expectation of inflation. And so they see themselves as lucky for having entered this period when the expectations are not so out of hand. And that's what makes them at least argue that there's a case for a potential soft landing, is that if expectations are not out of control, that gives them time to bring inflation down a little less drastically. But it's not looking great.
Yeah. So full steam ahead for the Fed, despite some of this malfunctions in global markets in Japan and UK and probably Europe. You see any risks with what's happening to have some counterparty risks here in the U.S. with some of these banks looking? Let's talk Credit Suisse.
Yeah.
What do you think of that situation?
Well, I think that's what convinced me that we were in a new financial crisis period. Like when we went from the Bank of England concerns to Credit Suisse within the same week, that was just that took me straight back to covering 2007 and 2008, where
it was like a lean-in.
Every time you turn the page and you turn a corner, there's a new major risk factor out there. And the exposures and linkages, to your point, are widespread. As you know, the US and the European financial systems, the economies might be fairly insulated from one another, especially the US economy vis-a-vis Europe, but the financial system is not. And to the point that I was making earlier, they've kind of hyper-regulated the banking sector post Dodd-Frank, but allowed the leverage to go into the less regulated parts of the system, and we really don't know where that game of whack-a-mole is going to pop, rear its head. And those are the risks that they're paying.
Okay, so being a veteran of previous financial crises, what are you really paying attention to going forward, Pedro, to see if this is going to be, let's use a Bernanke term, contained? So since he won the Nobel Peace Prize, let's give him kudos for contained.
So two things. I think one of the main risks is Treasury market liquidity, which has been challenged for various reasons, including the size of the market, the size of the Fed's presence in the market. And that's, of course, what forced the Fed to intervene in March 2020, and they would certainly do so again. And that would put them in a really tight Bank of England-like spot of having to do a little bit of QE on the side while at the same time trying to do QT. And I'm not sure how long they could hold that inconsistency. And the other spot is really credit spreads, because I think that even though the Fed talks about financial conditions broadly, what they really worry about, what really keeps them up at night, is the potential for, kind of cascading corporate defaults if we were to enter a deeper recession. So I think if credit spreads really blew out, then that might be significant for the Fed. When you ask me about full steam ahead, I think it is full steam ahead for now. They are getting to the point. I think that one of the reasons the market is trying to guess the pivot timing as well is that the Fed has given us some forward guidance that it's going to get to 4.5%, and just mathematically that means one more 75 and one more 50, right? But the big question is, they also had previously given us guidance that rates were going to peak at 1.9, and then they were going to peak at 2.8, and then they were going to peak at 3.8. So the question is whether you believe that 4.6, and whether you believe that inflation is going to cooperate enough between now and early next year to give them cover to slow the pace of hikes. And that's a big question still. So,
well, you talk about them maintaining their credibility on the fight of inflation. I think this is, like the sands in the hourglass. This is the last, I think the last chance they have. Was I reading something correctly that there is some type of institution that if they felt the Fed was not doing their job for financial stability, that could step in and, do something that is outside of the Fed's purvey?
Not other than Congress. I mean, Congress is the boss of the Fed. So the only institution that could step in the Fed's, in lieu of the Fed would be Congress. And of course, Congress did do so last time with TARP, right? TARP was a bank bailout that was fiscal in nature because it came from the Treasury, and so that would be sort of the extreme step.
Okay, well,
to the point about credibility, and I see some of the notes here in the chat about the rich point about the Fed taking a hit to its credibility, and that point is well taken, because I think that the Fed talked about front loading, and the reason they're doing 75 basis points is that they're front loading. That might have been the case if they started with 75, right? But they actually started with 25, then they went up in March, then they went up to 50 in May. So they're actually playing catch up, and I think, I've argued recently that the fact that they're going in 75 basis point increments is already an admission of a policy error. People think of the policy error as being in the future, like the Fed's going to over tighten, cause a recession.
Right.
But the
they were
policy
slow
error,
here too.
Yeah, it's the lack of reaction to inflation that is forcing them to act in an almost emergency type manner. And we've gotten used to 75, but these are emergency style moves, right? They're just like one step short of an intermediate emergency hike. So,
okay. A dose of reality for our audience here today, Pedro, that although, trick or treat, Halloween and the holidays are here, there are some stresses, and people have to be good stewards and shepherds of their capital for their families during this time, that we may be in an environment where return of equity is more important than return on equity.
Absolutely. And not to mention year-end kind of funding stresses take place anyway, right? And in this environment, they're likely to be supercharged. So I am concerned about what liquidity might look like in treasuries come the holidays.
Okay. Can we wrap it with your view on the CBDC?
I don't have a particular view, to be honest. I mean, I have a view on the likelihood that it will get off the ground. I would love to hear your take on it. My take is that it's not going to get off the ground anytime in the near future.
Great news.
That the Fed, the Fed floats it because it's sort of it's trendy. Yeah, it's trendy.
I mean, didn't President Biden sign some executive order to move forward with doing it?
That's right. Okay. But I think we're still so far away from actual, realization of it. And when you hear, I think Powell was on a panel the other day with the Bank of France, and there was various, there was the head of the BIS and Lagarde was on it. And they talk about it so much more concretely in Europe than we do here. Like Powell talks about it like it's in the very beginning, exploratory phases. And Lagarde talks about it in much more concrete terms. So my sense is that, and I've heard folks like Neil Kashkari and others at the Fed talk about, we don't understand what the problem is that CBDCs are trying to solve. So that sounds to me like it's not really something that they're keen on doing.
Okay. All right. Well,
I tend to agree. I don't understand the problem that it's trying to solve. Kashkari made a funny point about he was on a panel the other day, and he was saying that he challenges people every time, like, tell me a transaction that you could not have made without
the digital.
Right. And the only example that he could find was when somebody was trying to smuggle arms into Ukraine to help the war, and they could only buy weapons with Bitcoin. And he's like, okay, if you want to be an arms dealer, then maybe Bitcoin is the one for you. But otherwise, there's no particular use. So.
Well, we know what a powerful lobby they are. So it's great news. I'll sleep better. Pedro, thanks so much for being here again, and giving us what you see and not sugarcoating it. And really appreciate your views. You bring a lot of credibility to the table, and I want to show our audience where they could find you and other great writings for a resource at MNI. And Pedro's a columnist there and does some great stuff with Fed governors and former Fed people. And you're a watchman for people when it comes to trying to understand an opaque institution like that's trying to be transparent, but their transparency confuses most people.
Absolutely. I try my best. I like to say that nobody grows up dreaming they're going to be a Fed reporter, but I did. my only professional aspiration was that I wanted to be kind of at the center of policy action. I didn't think guesstimating the level of rates was going to be it, but here we are. That's where the action is. So.
It is, especially now the way all the ranges, the daily average trading range on notes never used to be like this.
Absolutely.
Even in the heyday. So Pedro da Costa, everybody. Thank you, Pedro, very much. Let's get back together in the winter and see how things are developing then. Okay.
Thanks
All
very
right,
much.
Pedro DaCosta, everyone. Follow him on Twitter at P DaCosta.
P DaCosta, you got it.
P
And also
DaCosta.
check out my podcast, which is called Fed available on
Okay.
Spotify and iTunes.
Oh, okay.
It's
All right.
also in the Market News website, and there's a if you're a Market News subscriber, you get the podcast. You get the podcast 5 days
here they
ahead
are.
of the rest of the world. So yeah, there it is.
Okay.
Yeah,
All
if you click on that real quick, because then we can show you the range of. I guess you can't see it there, but let me just, like, in the last 2 months, we've had 2 or 3 sitting Fed officials, 2 or 3 research directors, like really high quality people. I actually have a podcast today coming out with Olivier Blanchard, former IMF chief economist. So look out for that.
All right. Pedro, with his ear to the ground and that things are shaky. First time I've heard you talk like this, Pedro. So thank you very much for sharing your candid views with us today.
My pleasure. Thanks for having me, Dale.
All right, buddy. So that's a wrap, everyone. You could join the team in 20 minutes on the Morning Edge. Remember, don't just count your pips, count your blessings, and be a good steward in this time. And take care, shepherd your resources, and only take managed risk. Managed. Adios, everyone.
Bye, guys.
See you, Pedro.